New York City, October the 23rd, 1929. A department store owner named Charles sits in his broker's office on Broad Street and watches the ticker. He's not panicking. The papers have been calling for weeks: volatility, corrections, temporary dislocations. He has $60,000 in the market and $22,000 in his savings account at the Bank of United States. His broker tells him to hold. His bank manager tells him his deposits are safe. He believes both of them. 24 hours earlier, across town, a different kind of meeting was taking place. J.P. Morgan partners, senior officials at Chase National, and a small group of investment bankers had gathered at 23 Wall Street. They knew what Charles did not, that the levees were breaking. By the time Charles's branch opened on October 24th, those men had already moved. Charles would spend the next 3 years trying to recover what he lost in the next 3 weeks. What happened to Charles wasn't bad luck. It wasn't poor judgment. It was the consequence of a structural asymmetry that has existed in every major banking collapse in recorded financial history. A gap between what institutional insiders knew and when ordinary depositors found out. The gap is never random. It follows a pattern. And the pattern, when you map it across 1929, 1931, 2001, and 2008, is almost identical each time. This video is a forensic breakdown of that pattern, what the moves were, how they were made, and what the same playbook looks like in the language of today's financial system. Every time a bank closed in history, the same group of people saw it coming, and they all did the same thing the night before. 1929. The information architecture of the crash. The Great Depression bank closures didn't happen in a single day. They cascaded over 3 years. From October 1929 through the bank holiday of March 1933, during which Franklin Roosevelt suspended all U.S. banking operations by executive decree. In that window, approximately 9,000 American banks failed, according to the Federal Deposit Insurance Corporation's historical records. Total depositor losses exceeded $1.3 billion in 1930s dollars. What the FDIC records don't show is the withdrawal pattern in the 48 hours preceding each closure. Milton Friedman and Anna Schwartz, in A Monetary History of the United States, Princeton University Press, 1963, documented the sequence. Institutional investors and large depositors consistently reduced their bank exposure in the weeks before publicly visible stress. Not because they predicted the crash, but because they had access to information flows that small depositors didn't. Correspondent banking relationships, interbank lending rates, and private wire communications between major institutions created an early warning system that was structurally inaccessible to anyone without an account large enough to warrant a personal relationship with senior bank management. Charles had a savings account. He got the newspaper. The Morgan partners had a seat in the room where the decision was made. The mechanism wasn't insider trading in the legal sense. It was structural proximity to information. The two look identical from the outside. 1931. Credit Anstalt and the 24-hour window. The pattern sharpened in Europe 2 years later. On May 8, 1931, the Austrian government quietly informed a small group of senior creditors that Credit Anstalt, Austria's largest bank, holding roughly 70% of the country's total industrial investment, according to economic historian Barry Eichengreen's Golden Fetters, Oxford University Press, 1992, was insolvent. The public announcement came on May 11th. In the 72-hour gap between private notification and public disclosure, The institutional creditors who had been informed executed an orderly reduction of their exposure. Foreign banks called in short-term loans. Large domestic depositors with board-level connections withdrew. The mechanism was deliberate, documented, and legal. Creditors had been notified through official channels, and nothing in Austrian banking law in 1931 prohibited acting on that notification before it became public. When ordinary depositors read the announcement in the Wiener Zeitung on May 11th, the institutional money had already left. The credit Anstalt failure triggered a banking contagion across Central Europe that contributed directly to Germany's banking crisis of July 1931, which in turn accelerated the conditions that produced the political instability of the following decade. The mechanism that started it, a 72-hour information gap between insiders and depositors, was not a flaw in the system. It was a feature of how the system communicated. That figure, 72 hours, should terrify you. Not because it happened in 1931, because the same gap existed in 2001, and again in 2008. 2001. The Corralito's quiet warning. Argentina's bank freeze of December 1st, 2001 was announced on a Thursday. By the following Monday, ATMs across Buenos Aires were showing withdrawal limits. By mid-December, the Corralito was in full effect, a complete freeze on savings withdrawals. What Argentine financial historians have documented in the years since is a consistent pattern of large deposit outflows in the weeks preceding the formal announcement. According to research published by the Centro de Estudios de Estado y Sociedad, major institutional depositors and high-net-worth individuals with banking relationships at the executive level began moving dollar-denominated deposits offshore through legal transfer mechanisms in October and November 2001, weeks before the freeze was publicly contemplated. The mechanism this time wasn't insider notification. It was structural access. Argentine banking law required no disclosure of large withdrawals above a certain threshold, and the institutional framework for transferring funds internationally was available only to depositors who maintained a specific class of account with specific documentation requirements. The average retail depositor had a savings passbook. The wealthy had private banking relationships with transfer authority. The Corralito froze what was left. The people with the right account type and the right relationship had already moved theirs. 2008. Washington Mutual and the final 24 hours. The most documented version of the pattern in the modern era is Washington Mutual. WAMU was seized by the FDIC on September 25, 2008, the largest bank failure in U.S. history at the time, with $307 billion in assets according to the FDIC's receivership records. What the receivership records also show is that WAMU experienced approximately $16.7 billion in deposit outflows in the 10 days preceding seizure. The FDIC's own post-failure review, published in 2008, noted that the withdrawal pace accelerated sharply in the final 48 hours. Who was withdrawing? The FDIC's analysis identified the pattern. Institutional accounts and large commercial depositors moved first. Retail depositors, individuals with standard checking and savings accounts, withdrew later, after the institutional signal had already been processed. By the time the average WAMU customer saw the news headline on September 26th, the institutional money had been gone for days. This isn't a conspiracy. It's a structural outcome of how information moves through a tiered banking relationship system. Institutional clients have treasury managers who monitor interbank credit default swap spreads. market instruments that price the probability of a bank default in real time. In August 2008, WAMU's CDS spreads were signaling severe distress, according to Bloomberg financial data from that period. Anyone watching those spreads had a several-week head start on anyone reading the news. Retail depositors don't have Bloomberg terminals. They have CNBC. That's the historical record. Now here's why it matters today. The pattern. Extracted map. The four cases against each other in the same three-layer structure appears every time. Layer 1. A private information signal. Either direct notification to institutional creditors or market instruments that price bank distress before public disclosure. Layer 2. A legal transfer mechanism available only to a specific class of depositor. Private banking relationships, offshore transfer authority, institutional withdrawal infrastructure. Layer 3. A time gap between when the signal is available and when it becomes public knowledge, ranging from 24 hours to several weeks. The wealthy didn't predict these collapses. They didn't need to. They were structurally positioned to receive the signal earlier and had the infrastructure to act on it faster. That's not the same as prediction, it's access. The question worth asking is not, how do I predict the next bank closure? The question is, am I positioned to receive the signal at the same time as the people who moved their money in 2008? What the playbook looks like today. The modern equivalent of the 1929 information asymmetry is the CDS market. Credit default swap spreads on major financial institutions, which are publicly accessible through financial data platforms and price the market's real-time assessment of default probability for any covered institution. In the weeks before SVB's collapse in March 2023, its CDS spreads were widening significantly, according to Bloomberg data cited in the Federal Reserve's SVB Postmortem Review, published in April 2023. Institutional depositors watching those spreads had a signal weeks before the bank run became public. SVB's collapse followed the same pattern. According to the Federal Reserve's review, approximately $42 billion in deposits was withdrawn in a single day. March 9th, 2023. The withdrawal was led overwhelmingly by venture capital funds and institutional depositors who had received direct communication from fund managers about SVB's balance sheet exposure, which had been partially disclosed in an 8K filing the previous day. The retail depositors, individuals and small businesses who didn't have a fund manager sending them a memo, found out from Twitter. The information gap still exists. The transfer infrastructure still favors institutional depositors. The pattern still runs on the same 24 to 72 hour logic it ran on in 1929. The only thing that has changed is the speed of the signal and whether you're in a position to receive it. Charles, the department store owner from Broad Street, eventually rebuilt. It took 11 years. He never fully understood what had happened to him. Not the mechanism, not the structural asymmetry, not the 24-hour gap between what the Morgan partners knew and what he was told. He assumed he'd been unlucky. He had been uninformed. Those feel the same from the inside. They're not the same thing at all. The playbook hasn't changed in 100 years. The players have access to faster tools. The gap between when they receive the signal and when you read the headline is measured in hours, not days. But the gap is still there. Understanding it exists is not the same as having a Bloomberg terminal, but it is the beginning of not being the last one to know. History already taught you this. Nobody showed you the receipt. If you want to keep reading the receipts, We perform economic autopsies here so you don't become the next case study.